you ever felt like investing is just too complex? Certainly movies and TV shows make you think that you need to have a team of analysts and sophisticated algorithms to beat the market. Well, Warren Buffett, one of the most successful investors of all time, proved that sometimes the simplest strategies can outperform even the most complex ones. So in this video, I'll share a little bit about Warren Buffett's famous bet against the hedge fund industry and how his simple investing strategy came out on top. We'll also discuss the 3 lessons we can learn from this and how you can apply them to your own investment journey as you prepare for retirement. Now, when the first index mutual fund hit the market in 1976, many professionals in the finance industry lambasted the idea. The objective of an index fund is to essentially just match the performance of the index that it tracks, not to try to outperform the given market. So critics at the time, they thought this meant settling for mediocrity. And many people still think that way today. In Canada, based on this active versus passive report from PWL, still about 85% of Canadian investors allocate their money this way. But legendary investor Warren Buffett believed that index funds could achieve better returns for long-term investors than these actively managed hedge funds. And so to see if he was right, Buffett issued this fascinating challenge to the entire industry back in 2007. He wagered that over the course of the next 10 years, an unmanaged, low-fee S&P 500 index fund would outperform those hedge funds chosen by a professional. Buffett expected a bevy of hedge fund managers who would eagerly accept his bet. After all, Wall Street, and especially these hedge fund managers, they had a bit of a reputation for arrogance. Surprisingly, he was met with silence. Finally, a single hedge fund manager accepted the bet. They selected 5 hedge funds and they put it up against this S&P 500 index fund that Buffett chose. The investor whose fund yielded the greatest returns, minus fees, over the course of the next 10 years would receive $1 million to the charity of their choice. Now, during the first year, Buffett's index fund was losing big time. You recall the time of that bet, just kind of coming into the top of the great financial crisis, not a great entry point that even Buffett didn't predict. But the index fund outperformed the hedge funds in the long term. By year 10, Buffett's index fund returned over that time period 7.1% on an average annualized basis, whereas the 5 hedge funds averaged 2.2% annually. Buffett's simple strategy was so far ahead of the hedge funds that the manager actually surrendered months before the 10-year time frame was officially over, and Warren Buffett actually received $2.2 million to donate to charity that empowers young women. And by the way, if we haven't ever met, I'm Steve Willems. I'm a wealth advisor with the Willems Wealth Planning Group out here in BC. We started this channel to help you plan for your own retirement, helping you think about how to arrange and plan your investments, your income streams, and ideally have you pay less tax along the way. Now, there are a few key lessons that we can learn from Buffett's bet back in the day. The first is just that simplicity can outperform complexity when it comes to investing. Now, the sore truth is that complexity sells better. It has this kind of morbid attraction to us. When we look at a simple strategy, it feels like you're being cheated, like it's too easy, while complexity gives you the impression of control. Kind of fiddling with the knobs makes you feel more capable of handling a situation or the volatility of life. While the simple path, it sounds naive, maybe even clueless. Now, this is true in investing, but it's also true in life. In the endnotes of his brilliant book, Winning the Loser's Game, Charles Ellis wrote about his 2 friends who, at the peak of their careers in medicine, agreed that the 2 most important discoveries in medical history were penicillin and washing hands, which of course stopped the spread of infection. Now, these authors' 2 friends also suggested that there's perhaps no better advice on how to live longer despite all of this medical evidence than just quitting smoking and buckling up when you're driving. The takeaway? Advice doesn't have to be complicated for it to be good. Now, the second, lower cost strategies have a higher probability of outperformance for long-term investors. A contributing part to this gap from the Buffett story came down to the implementation costs of the 2 strategies. Lower cost versus more expensive. And if this was just a one-off story, we might be able to call it anecdotal. But the data backs this up. You see, every year, Dimensional, they're an investment management company based in the US, they produce a fund landscape report that calculates the likelihood of higher costs reducing performance. And here's what they found. Not unexpectedly, but funds with higher average expense ratios had lower rates of outperformance. And for the 20-year period, all the way through to 2023, 6% of the highest cost US domiciled equity funds and only 8% of the highest cost fixed income strategies actually outperformed their benchmarks. That's crazy. Just imagine that. For 20 years, only 6% of equity funds and 8% of fixed income funds actually beat their benchmarks over that 20-year period. Now, cost isn't everything, but this data highlights that it's a pretty important element in the decision. Just look at how these probabilities change as the implementation costs decrease. Now, third, you got to know what game you're playing. Warren Buffett knew what game he was playing. Are you trying to find the winners? Are you trying to avoid the losers? Or are you just going to take it as it comes? In his insightful memo, Fewer Losers and More Winners, Howard Marks from Oaktree Capital highlights the key question every investor should ask themselves is whether they have the ability to produce asymmetry, the potential for outsized gains relative to the risks being taken. If you don't, he suggests sticking to a more passive, diversified approach rather than chasing the winners through these bold bets, as we saw these competing hedge fund managers do just a few seconds ago. Now, Warren Buffett, arguably one of the best active investors in our age, is widely described as only having 12 great winners in his entire career. His deceased partner, Charlie Munger, was even more frank. He admitted that the vast majority of his wealth came from not 12 winners, but 4. So they had a good number of investments that did decently well. They had a few of these really big winners that they had invested heavily in and they held for decades, and they had relatively few losers. Now, no money manager can ever be expected to have all winners and no losers, but admittedly, most of us wouldn't hold ourselves up either to the likes of Warren Buffett. So whatever strategy you choose to adopt as a part of your investment strategy, maybe an active strategy where you're looking for those winners and trying to avoid those losers, or maybe a more passive approach, maybe even an unremarkable approach, it's even more important that you just know what game you're playing. It's fine for different people, different retirees to play completely different games as they plan out their retirement. Don't take cues and advice from people playing a different game. Now, one of the keys to Buffett's success, beyond this kind of winners and losers dynamic, is that he's just been playing his game for so long, and he's been able to compound his money over decade after decade. So a good question for you, frankly, for all of us, is what are the best returns that we can sustain for the longest period of time? So not just what are the best returns I can earn, because those returns come with risk. It's how long can I endure them and how long can I earn those returns for? For Buffett, this was the game that he was playing, and hopefully those lessons are helpful for you as well. So that's it. Simple often trumps the more complex, and spinning off this kind of cool Buffett story, we pulled those 3 other lessons for us here today. I really hope that was helpful. Thanks again for watching. I'll see you in the next video.